Hi folks, and welcome back to Meaningful Money. Okay, here we are back outside again, still here in my field just outside St Buryan. Beautiful May evening. Just good to be outside after being stuck inside with the rain for about 3 weeks. Carrying on talking about asset allocation. We talked about it briefly last time and introduced it in a sort of theoretical way, so we're going to carry on talking about that and put some meat on the bones. But before we do that, my friends down here in the bottom right, I must thank them. That's 7 Investment Management, because they continue to sponsor me here on Meaningful Money, and I'm very grateful to them for doing so. Now, remember we talked about the Brinson study last time, which is how important asset allocation is to the returns on any given portfolio. We talked about strategic and tactical, long-term and short-term asset allocation last time. We're going to concentrate on strategic asset allocation this time, the sort of long-term view, and ask, how do you get that right? Where do you even begin? Now, remember our three factors rather. Risk, the amount of risk you're prepared to take with your investment, the time scale you're working over, and the returns that you want. Keep those in mind as I talk here. Where do we even begin? Well, we have to begin, I believe, by looking back. Now, whenever you take out an investment, if you look at the small print on the advert or whatever that you've chosen, or on the application form or something, it will say, past performance is no guide to future performance. That's a sort of regulatory thing. I have a bit of an issue with that because it has to be some sort of a guide, surely. It's certainly no guarantee to future performance, but it is a guide if we look back far enough and sort of use the data intelligently. So let's just say, let's talk about UK shares, right? UK equities, UK shares, shares in British companies. Let's say you want to invest over a 10-year time period and you want to have a good guess at how UK shares might behave over the next 10 years. Well, one thing that you could do is look at lots of 10-year slots of time. Let's say you go back to the early 80s and you look at how UK shares did between, for example, January 1982 and January 1992. And you look at what the performance of UK shares was in that 10-year window. And then you shunt everything forward by a month and start in February 1982 and go to February 1992. And you look at how UK shares did in that 10-year period. And you do that all the way forward to, the 10-year period that just ended here at the end of April. And you measure how UK shares performed over each of those many 10-year blocks. And you look at that data and you see that the average return is 10% a year. I've made that figure up, by the way. I have no idea what it is. Couldn't be bothered finding that out. But you also note that the variance, the sort of difference, if you like, the average is this, but the sort of upside and top side, the variance is 8%. So let's just say that your best return then you can expect to be 18%. So that's the 10% average plus 8. And the worst you can expect on average over those 10-year, all those 10-year periods you looked at, would be 2%. That's the average of 10 less the 8% variance. So time, 10 years, return, 10% on average over the 10-year periods that you've looked at, and the variance is plus or minus 8%. All that does is it gives you an idea of how things have behaved in the past and how they may behave in the future. But that's just UK shares. You've got tons of things you can invest in. So you would need to do that same exercise for US shares, European shares, Far East, and then all the other things you can invest in as well, gilts and corporate bonds and all that stuff. And look back at the data, get enough data for it to be meaningful, that word again, and then add it all together. What you do then is remembering your risk tolerance, how much you are prepared for your portfolio to fluctuate, and remembering the return you want, you should be able to find a sort of optimum blend of assets, an optimum mix of stuff you can invest in to give you the return you want with the risk you're prepared to take. Now that sort of optimum point is called the efficient frontier. Now I'm going to caveat this. If there's any advisors watching this, I know this is simplistic, but that's the whole point of this website. There is tons more to it than that, and hopefully if you're watching this you can understand that there's some fairly intense maths involved and some research involved in putting together an intelligent, scientifically invested portfolio. This is why I don't do it, and we at my company at Jackson's, we outsource it. So you can choose your weights depending on your needs and your risk profile, and build this blended sort of awesome neutral portfolio, which is perfect for the returns you want and the risk you're prepared to take, right? It's not just about averaging. You must be aware of other things like correlation, how assets behave relative to each other. That just makes the maths more complicated. But what that will do, if you do that and prepare to sort of take that step, is give you a neutral or long-term strategic asset allocation. But if you just stick to that, it's almost a little bit blind. And people do, often, lots of investment managers do that, stick to their long-term plan and don't move from it. But I believe there's a place also for something called tactical asset allocation, which is how you skew that sort of optimum portfolio based on what you think is going on right now. So we've got French elections going on at the moment. We've got the American elections later on in the year. We've got the Eurozone mess rumbling on. How do those things make you feel right now, and should you alter the weights of the different assets in your allocation based on what's happening right now? A good manager, an active manager, will do that. And that's called tactical asset allocation. I'm going to put a little bit more meat on the bones of that next time. So for now, thank you again for watching this one. Great to be out in the sunshine. Hope that it'll continue. But thanks for watching, and I'll see you next time.